Welcome back to my YouTube channel. In today's video, we're going to be talking about order blocks. We're going to go over what they are and how to utilize them in our trading. Now, before we get started on the charts for our live examples, we're going to head over to the Currency Pros ebook, which is exclusive to our private Discord community, but I'm going to share this one page with you just so we all have a firm understanding of what order blocks actually are. So let's run this down and then we'll dive into the TradingView charts to go over some examples of how to identify and how to trade order blocks. So basically, institutional money enters the market algorithmically at key levels in increments known as order blocks. So rather than entering hundreds of millions in currency into the market at once, institutional orders are broken up into multiple entries, creating tight consolidations that we see right before an impulsive movement in the market. This method leaves behind an institutional footprint on a chart that can be identified and capitalized on. Now, the most important thing to understand about these institutional orders is that there is no protective stop loss being used. The reason for this is because institutions hedge their positions. That means buying and selling simultaneously. You may be wondering, why would they do that instead of just using a stop loss? Well, the answer is simple. Institutions move the market. They do not lose. They also have very deep pockets and they can withstand severe drawdown. Now, let's say a short position and a long position are taken at the same time at a key level in the market. Market momentum dictates price to move higher in favor of the long position. That still leaves an unattended short position in drawdown, unrealized loss. Once the long position has reached the desired target, price must then retrace back down to the short position's point of origin to mitigate the unrealized loss. Once the loss is mitigated, more often than not, price will continue in favor of the dominant trend's momentum. So during this process of order block mitigation, retail traders are busy focusing on double tops, flags, double bottoms, Fibonacci levels, moving averages, trend lines, etc., that have nothing to do with why price does what it does. So this allows institutional money to play with retail traders and liquidate their positions in the form of stop hunts or fake outs. I'm sure you guys have heard these terms before, but the truth is this is simply institutional algorithms doing what they were designed to do. So now that we've gone over that introductory breakdown of what order blocks actually are, let's dive into the charts to go over some examples of how to identify them and how to use them in our trading. All right, so we're taking a look at Euro USD and we're currently on the 15-minute time frame. Now we're going to go over some examples of order blocks here and how to utilize them in our trading. So before we get too ahead of ourselves, I just want to mention that the term order blocks, it's basically supply and demand, but very refined. Okay, so the order block itself is just the refined section of the supply or the demand, depending on which market we're currently in. So the main thing that prompts me to look for an order block is a break of market structure. That means a break of a high or a low. So in this case, we have a clear bullish market. We're creating consistent higher highs and higher lows. So I'm going to look for the most recent break of structure. So in most recent price action, we obviously have a high here, we have a low here, and then price gained bullish momentum and broke through that high, creating a break of structure and forming a new high. So right away, I'm going to label with the arrow tool. I'm going to label this as a break of structure. So as soon as I've identified a break of structure, I have to look for its point of origin, which is the order block. Okay, so technically this entire area of consolidation right here is demand. Okay, this is where demand is formed. This is the consolidation prior to price gaining bullish momentum and breaking structure. So there's a lot of orders within here. There's a high chance that price is going to come back to this zone and mitigate it. So this is the demand zone altogether, which anybody who understands basic supply and demand, you'll grasp this concept pretty quickly. The order block is simply a refined version of this demand zone. So basically, in a bullish market, it is the last down candle before the up move. So in this case, it would be this candle right here, right? This bearish candle prior to this bullish candle, creating huge momentum and breaking structure. So in this scenario, this is the order block. Okay, we'll go over some bearish examples later on, but let's focus on this bullish example for now. So what I do here is, now that I have my order block refined, my demand level refined down to this order block, I'll drag out my rectangle tool. And this is the area that I'm looking for price to mitigate something like this, before taking off in the original trend's direction, the dominant trend, as I mentioned in the ebook. So the dominant trend here is clearly bullish. We're looking to continue that order flow. So we're anticipating price to mitigate this order block here and then take off from there. So this is the area where we're going to be looking for entries. Now there's a couple different ways we can approach this. Typically it's done with limit orders. So in this case, it would of course be a buy limit order. And for the simplicity of this video, we're going to, actually, let me delete this. What I'm going to do to reduce the stop loss size, because this is most likely going to be a very large stop loss, you can either use the Fibonacci tool or the Gann box tool, highlight the same order block, but only use the 50% level on these tools. And we can actually set a buy limit order at the 50%. That will allow us to have much better risk to reward. We're just going to cover this low right here. Our stop loss is just going to cover that low. So we can do 15 pips even. That should be okay. Let's just extend this out a bit more just in case we need some more room. And the minimum I like to target for profit is 5R. So let's see if we can get 5R at this high. No, I'll still extend it to 5R anyways, because it's not too much past that. Okay, so we have a nice potential 5R trade setup right here. And keep in mind, this is a riskier way to trade, just setting a buy limit order at the order block. Within our Discord community and within our full video course, we teach a much more refined process that adds a lot of confirmations and confluences to validate this order block. This is what we call a risk entry, basically just setting the order at the order block and just hoping that it holds. Oftentimes it will. This is still a very high probability of way to trade, but sometimes it'll just barrel right through and change trend direction. So like I said, within our Discord community and within our video course and the ebook as well, which you just saw a glimpse of, we do teach a much more refined way to entry, but this is still a very valid way to trade, and I'm happy to share it with you guys here on YouTube. So now that we have our order set here, the dark gray is our stop loss, the light gray is our profit region, the very top being our full take profit at 5R. Let's play this out and see if we get triggered in and see if it plays out in our favor. Okay, so that probably wouldn't have tapped us in. Maybe, really depends on the spread that you have with your broker. Let's just move this whole thing over. And let's see if we actually get tapped in. Okay, so right there you can see our parameter tool has been triggered. Let's just move this over to clean it up a bit. So we're now in the trade, roughly 1R in profit right now. Let's continue to play this forward and see how it goes. Okay, wow, that was quick. Okay, most likely a news-related event that caused that level of momentum. Regardless, the analysis remains the same. That's the beautiful part about trading order blocks, is that when you have a firm understanding of the technical analysis on the chart, you don't really need to pay attention to news events. Oftentimes it still works in our favor. So this was a good example of how to locate an order block and how to set a trade based around it. So just to quickly run this down again, we look for the break of structure first. There is no valid order block unless there is a valid break of structure. So we look for, in a bullish scenario, a high, a low, and then we're looking for that high to be impulsively broken, which we can clearly see here. Once we locate that break of structure, we simply have to locate the point of origin for that break of structure, which is the order block. Now in a bullish scenario, like I said, we're looking for the last bearish candle prior to the bullish move. So that would be this low momentum bearish candle right here. Another thing to mention is that this pattern typically comes in the form of an engulfing candlestick formation. So as you can see, this is the typical bullish engulfing formation. We have a small bearish candle and a large bullish candle that fully engulfs the prior candle. So that is a great example of a high probability order block, okay? And like I said, it's just a simple way to refine the demand zone, because this entire consolidation is the demand zone. An order block is simply the refined section of that demand zone. And that's what we target for our entry, because price is drawn to this area like a magnet to mitigate open orders. Once it does, we take off. Okay, so now we're taking a look at USD JPY, and we're currently on the 1 hour time frame. So in recent price action, we can all see that price was quite bullish, right? Clear higher highs and higher lows in a very well-respected uptrend. But in most recent price action, we've seen a clear break of structure. So this was the most recent low, and this massive bearish move clearly broke that structure, okay? So what do we do after we locate the break of structure? We locate its point of origin. So as I said in the previous example, technically the supply and demand zones are the entire consolidation, right? The order block is the refined point of that consolidation. So in this bearish example, to find a bearish order block, we're simply looking for the last up move before the down move, okay? So the last bullish candle prior to the bearish impulsive move to the downside. In this scenario, let me just zoom in a bit so it's a little more clear. There's one that stands out the most, of course, and that would be this low momentum candle right here, right? That small bullish candle prior to the massive bearish impulsive movement to the downside that was responsible for this break of structure. It actually broke multiple structural points along this bullish trend, so this is going to be a clear order block that we should target for an entry. All right, so now that we've located the order block, let's drag out our rectangle tool. Nice and far, give ourselves enough room. And we're gonna go ahead and set a short position right here. Let's go on the low of the order block this time. What can we get away with here? We can get away with a 15 pip stop loss. That should be fine. Just like the last example, actually. So the stop loss placement is quite simple. We just want to place it just above the order block in this bearish scenario. If it was a bullish scenario, we want to place it just under the order block or the recent low, okay? This order block here actually does represent the recent high, so we just want to keep our stop loss just above there, because if price invalidates this order block and trades higher, we wouldn't want to be in the trade past this point anyways, because if we're surpassing this high, that means bullish structure is taking control once again. So we wouldn't want to be in a selling position, right? So the stop loss always has to be placed at a point of invalidation. So that's exactly what we've done here with this 15 pip stop loss. Now in terms of take profit, I typically like to just target recent lows. So that would be this right here. Another thing you can do is target the next bullish order block. But oftentimes if the market structure is very clear and concise, then you just want to target the lows because there's a high chance that there will be a new bearish break of structure in this case, for example. So we know that at a bare minimum, this low would be taken out. So that would be a great point to target. Let me just delete that line. Let's drag the take profit all the way down to that low. And that gives us a nice 5.69R. So that would be a wonderful position. Let's see if it plays out in our favor. Keep in mind, this would just be a sell limit order. I don't typically enter trades like this, especially on a higher time frame like the 1 hour. I prefer to refine things down to the 5 minute, the 3 minute, or the 1 minute. Sometimes the 15 minute. It really depends on the opportunity. Within our community, we teach a much more refined approach to this entry. So this is what we refer to as a risk entry. It is still valid in most situations. It just, of course, has a slightly lower win rate and a little more risk involved with it. So it would be good to risk a little bit less when you're taking these types of trades, but they do still have a very high probability of working out. So let's play price forward and see how this one goes. Okay, as you can see, we got tapped in right there. Let's move the position tool over. Immediate profit, almost 2R in profit. Let's continue this and see what happens next. Okay, more bearish momentum. That's a great sign. We broke this minor structure here. So very good sign of a healthy trade. Let's see if we get our full take profit, and we do. So 5.69R achieved in a very short amount of time using this very simplistic order block strategy. So just to recap things, we looked for the break of structure, right? We had bullish market structure, and then price very abruptly turned bearish, breaking this recent low. That prompted me to look for the point of origin that caused that break of structure, which would be this order block right here, the last bullish candle prior to the bearish impulsive move. That is the order block. I simply highlighted it with a rectangle tool, dragged it out, set a sell limit order on the low of the order block and placed my stop loss just above the high of the order block. Targeted recent major swing lows for profit and set it and forget it.